Well, that looks like a nice group of happy people. They're happy because they get group benefits. And group benefits tend to be tax advantageous, in many cases tax deductible. And that's what we're going to talk about for this session. First of all, definition of group benefits. Benefit packages for groups that provide tax advantage or tax deferrals. Very simple definition. Probably, I bet if we asked this before this class and everybody give a definition other than this, but this is the definition. IRS has always got different definitions than everybody else. Group medical plans. Employees can generally exclude the value of accident or health benefits from gross income of the employees. Major exception is 2% shareholder employees of an S corporation. Self-insured medical reimbursement plans that favor highly compensated employees are taxable income for payments made to the highly compensated employees. And I might note, anytime highly compensated employees get a better deal than the other employees, it's going to be taxable to them the entire value, not the delta between what the ordinary employees pay to what it is, but the entire value is. And I ran into that when I was working for a company in Camarillo. All the vice presidents, and I was a vice president, got absolutely free medical expense. That's what they told us. So you get a prescription, you just turn it in. In fact, you turn in a bottle of aspirin's receipts, they paid you back for it. Any medical or hospital bill, the bill was sent to the company. If you paid it, they reimbursed you within really a few days. The shocker was at the end of the year when you got your statement, because again, you didn't have the same benefits as everybody else. COBRA, Combined Omnibus Budget Reconciliation Act of 1986. Congress comes up with some weird names for their acts, don't they? It requires an employer who maintains a group health plan employs 20 or more employees to continue providing coverage under the plan to any former employees and any qualified dependents. And the qualified dependents also includes people get divorced, so when someone gets divorced from someone who's on a plan, they get the coverage. Again, it's for health plans, it's not for the other types of benefits. And the problem, quite honestly, is you're paying the employer's share plus the employee's share, and I believe they can also add a slight administrative charge in addition to the amount that the employer and employee had paid. Group disability insurance, tax deductible for the employer and tax-free for employees. Can be either both short-term insurance, less than 2 years. Here in California, that's a requirement for short-term, and long-term insurance also, if it's provided by the employer. Disability payments are taxable to the employee if the employer pays the premiums. So what typically happens on disability insurance is that the employer gives you additional money so that you can buy the insurance under the group disability rather than the employer pays for it. It's a big advantage, because if the employer pays for it, it's taxable. If you, the employee, with this extra money that they give you, buys it, then any benefits you get are non-taxable. And that's kind of nice when, if you break a hip or back and you're out of work for 6 months or a year or two, you're getting not 60% income taxed, but 60% of your income non-taxed, which basically puts you in the position you'd been when you were working, because it taxes the cost of going to work, etc. So, and the really cost of company is the same for either way. So, I always encourage companies to give the employees extra money, give them a pay raise, so that they can afford to buy the disability insurance rather than the employer providing it. And it's through the same insurance company, etc. And the insurance company usually takes care of the administrative cost of getting the information to employees and getting them in it. The frustration for a lot of companies is a lot of people don't take it, even though the probability of getting disabled for 6 months or longer is much higher than dying until you're 65 or older. So, and most people will have a disability during their working career, so it's really something people need. Cafeteria plans, I'm sure you've all heard of that. Some of you may be even under it. You're not quite sure probably what it is. It's defined as a written plan in which the employee may choose to receive cash or tax-exempt fringe benefits. Now, if you get cash, you're going to get taxed on it. The tax-exempt fringe benefits, you're not. And also, the tax benefits are usually very good because the company is buying a vast volume of services for a number of people, and therefore get rates that you ordinarily couldn't get on your own. It helps control costs of employers only paying for benefits that the employee actually uses, and certainly companies don't want to pay for extra benefits they don't have employees use. The Internal Revenue Service Code regulations determine the tax-exempt benefits, and if a highly compensated employees are favored, the value of the non-taxable benefits they choose will be taxable income for them, the entire value of it, not just the delta from what the rest of the employees. So you've got to be very careful if there's a discrimination in the area. Again, these have changed a little bit over the years, and I don't like to put them in as which are discriminatory, which ones cannot be, because again, it changes so often. Benefits include, in a cafeteria plan, first of all, we have accident and health insurance benefits, but not medical savings account, long-term policies, adoption assistance, dependent care assistance, and group term insurance. These are the most common. Now, a 401k plan could be included. Very rarely it is, but that is legal. No other retirement plan or pension would be allowed under the cafeteria plan, just a 401k. And again, that's very rare. It's usually separate. Flexible spending accounts, and there's a type of cafeteria plan which employees can choose to receive cash or deferred compensation as income tax and payroll tax free to fund the cost of certain employee selected benefits. Again, rather than the ones we talked about before, this is for some other types of benefits we'll discuss in a second. If employee does not make use of the part of all of the contribution amount within a certain time period, the contributions the employee did not use are forfeited back to the employer. So if we put aside $50 a month for extra health care coverage, and we only use, say, instead of 600 we use 300 of it, the other 300 go back to the employer. You're not allowed to use it as a reserve or carry it forward next year. Typical benefits in the FSA are health, dental, eyeglass, and dependent care. And certainly dependent care is one that is very valuable, probably more important than eyeglasses. And I would say also dental. I would say health care and dependent care are by far the most important, but dental and eyeglass being much less valuable. There's the Archer MSA and medical savings account. Contributions by the employer or by the employee, they either can do it. Earnings on assets within the plan are tax deferred until a distribution is taken. If distribution is for qualified medical expenses, the distribution is not taxable. If not used for qualified medical expenses and is distributed before age 65, the entire distribution is taxable and there's a penalty of 15%. And if saved till retirement, there is no penalty. So 65 becomes a magic one in that. The last year for establishing the Archer MSA was 2005. There are a lot of people I know who have it. It's a very good plan. It's basically one where it covers high expense. There's a deductible, and I don't remember what exactly the deductible is, but let's just arbitrarily say it's $5,000. At $5,000, you eliminate most of the medical expenses, because most people, $5,000 is about the maximum they spend in a year. Again, unless they're older or in bad health, or have a very bad accident or cancer. But we also have now health savings accounts. The HSA is very similar, but less restricted. The difference of the health savings account can be established by anyone. It requires a high deductible health insurance plan. Again, easily $5,000. Contribution can be made by the individual or the employer. Distribution taken before 65 for non-qualified expense have a 10% excise tax, a little bit different. And after 65, there is no penalty. So that you can use this actually as the parts that you don't use as a retirement plan. Let's face it, because it's going tax-free, so you don't pay the taxes until you turn 65. Now, I'm not sure how the Archer plan or the HSA will be changed by Obamacare. Again, I would suspect we will know in the next few years. VEBA's Voluntary Employee Benefit Associations was very big for many years. It has decreased in value because the government has gotten tighter on it. But I'll give you an example. In order to have the $50,000 of life insurance that's been mentioned several times in the course that's tax-free, you have to have 10 employees. And if I'm an insurance salesman, I have a secretary, and that's all I have, quite honestly, there's not 10 of us, but let's say on our floor we have 12 offices and we have 3 people averaging an office, so it's 36 people. We can use the Voluntary Employee Benefits Association. And I have several times in my career gotten together with other employers in the same floor or the same building so that we can get some of these benefits. First of all, there's a welfare fund provided by the employers in which they provide the funds. The funds are deposited to provide for specific benefits, and those qualified benefits are tax deductible to the employer and tax-free to the employees. And it can be done through a trust or a corporation. We actually had one of the medical service companies like Blue Cross Blue Shield, and I just use those as names, but actually did this for us, and they took care of the administration. There's an administration fee, but they did separate my business and my people from the other people, so that each business was able to have this separate. The things covered are, first of all, life insurance, which again, you have to have 10 people to have the life insurance. If you only got a couple, that's where this comes in if you get several together. Survivor benefits, which is death, sickness and accident benefits, vacation and recreational benefits, severance benefits, unemployment and job training benefits, disaster benefits, and legal services. Having talked to people, besides myself, but many others who have had this, by far the most common is the life insurance, survivorship benefits, and the sickness and accident benefits. Because again, a group of 10 or 12 gets much better rates than an individual. In fact, when I was in business, I had a very difficult time when I first started my businesses trying to get health insurance because I only had 5 or 7 employees. And then when the Vivas were available, I got together with other companies so that we could buy it. Salary continuation plans, an agreement where an employer pays an employee after retirement, and we covered this actually in week 7. It can be discriminatory because, again, the way it's set up, it's not tax deductible until for the employer such time as the employee gets it, or as it has a constructive access to it. It shifts income to a period where the tax burden is lighter, and typically funded via life insurance. And typically funded via life insurance was information I was given. I have not seen that experience myself because, again, companies do their funding of it different ways, but the source I had here, I believe, was the IRS or some reputable source equal to the IRS. Long-term care premiums paid for group plans are tax deductible for the employer and tax-free to the employee if plan only provides for long-term care insurance. They're not duplicate of benefits paid by Medicare. Plan must be a guaranteed renewable and pays only benefits if a beneficiary of the plan is certified by the licensed healthcare practitioner as chronically ill. Now, I might note that in some areas, including California, there's some plans that are not qualified for taxes, and you have to be careful. I think that general plans require 3 inabilities out of 7, and some of these other plans, which are a lot cheaper, only allow 2. But the 2 out of 7 that you can perform is not tax advantage. It's going to be taxable to you. So you got to be careful on what long-term care you have, and do your due diligence before you give the check to the salesman. Group retirement plan services, tax-free benefit if we provide retirement planning advice to employees and spouse, and employee maintains a qualified retirement plan. Now that sounds fantastic, right? The problem is, let's look at the exclusions. It does not apply for tax advice, for legal advice, for accounting advice, for brokerage services. I want to know what else there is. Serious, however, this is really telling people what they should do to adjust their life for retirement. I've worked in a lot of companies where it was not uncommon for people who were exempt to work 48 or more hours a week, and they would do this till the day they retired. The day they retired was a Friday always. Everybody would say goodbye to them, and then on Monday morning they had nothing to do. And it was some psychological problems, and sometimes even created physical problems from it. And one of the studies we had, and this is when I was at Hughes Aircraft Company, said that a lot of employees died within 2 years. Could have been because of various reasons, but they felt it was that people had a difficult time going from working 48 or 50 hours a week to doing nothing and not to know what to do with their time. And so this is the group retirement plan services, is to help people adjust to that. It's more psychological, obviously, than financial. Business continuation plans. Entity plan is where the business entity buys life insurance on owner's life to provide funds to buy out a partner or shareholder at death. I'm sure you covered that in your insurance class, you covered it in your estate planning class, maybe even in the fundamentals class. A cross-purchase plan is where the individual partner or shareholders buy life insurance on each other to buy out the owner at death of the insured. And again, the big advantage is there you get a stepped-up basis. Premiums are not tax deductible in either case, but proceeds are tax-free. And your choices are really the entity plan, where the entity buys it, or the cross-purchase. Those are the two choices. And the entity does not give a stepped-up basis, and where the cross-purchase does. In neither case is the insurance policy's premium is deductible, but you get the benefits of death tax-free in these situations. I might note that if you're a corporation that's getting it, the entity type, there's always a danger of outer minimum tax. Premiums are not tax deductible in either case I mentioned before. Benefit of the cross purchases, stepped up basis that isn't available under the entity plan. And really this is tough decisions for people starting a business. If everybody's the same age and the same health, pretty easy, that becomes cross purchase. When we have a partner who's maybe 28, and one 44, and one 53, that makes a difference because the 53 is going to pay much less for insurance than done by the 28-year-old. Now, a way to handle that again is if these are partners as opposed to a corporation or limited liability company, we can reallocate the profits and losses between the partners, and that could be some help for the 28-year-old. But again, limited to partnerships. Business overhead disability insurance. Premiums are tax deductible as a business expense. Benefits payable are taxable income to the entity. Key person insurance, very important. I have seen many businesses in my career that were small businesses, and even some medium-sized, where a key employee died and had tremendous effect on the company, where in some cases the company went under, in some cases they drastically reduced in size, and they always had financial problems unless they had one of these key person insurances. Now, when I'm thinking of this, I'm thinking of Apple Computer, and when Steve Jobs died, what was the impact? Actually, the stock went up, and because I think they followed his way of doing business. But they could, I'm sure they probably did have a key personal insurance policy on him, and that policy is used to make up for the losses because of the person's gone, and can also be used for recruiting somebody and the recruitment expense, and also maybe giving a bonus, signing on bonus to get the person. So key insurance policies have a lot of use. I've also seen where fathers would have, or mothers who had a business would use keep policies so that their money could be loaned to one of the children to buy out the interest of the other children in the family so that they could take over the business. So there's a lot of use of this insurance, and it's a relatively reasonable cost. The company pays the premiums and is a beneficiary, and again, in the case of the father, allowing the son to buy it as a loan in the contract to the child so they can use that funds to pay off the siblings. So you usually have a contract with many of these, as well as the insurance policy. Premiums are not deductible, but the death benefits are not taxable unless it's a corporation, and if it's a corporation, it's subject to outer minimum tax. Dependents of the deceased do not receive any proceeds. Again, unless there's a contract, again, such as that my youngest son Jerry is going to use it to buy out the 3 family members on a loan, and it has tax IRS level of interest rates for the loan. You can have a contract like that. That's the end of the lectures for this course. I think you probably learned a lot. There's probably a lot of stuff you learned that you probably want to forget, but it actually will be very useful for you in your career. And I wish you the best of luck on your final exam.